Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, or regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Stutland Managing Partner at Equity Armor Investments and Andraos, Partner at Regency Wealth Management. We're here to discuss the underlying fundamental reasons for the recent bout of volatility in the market. It is great to see the both of you. Welcome to Trade Talks. And Brian, it feels as if last week's job report was one of the catalysts to spur this volatility on. Is that one particular data point a trend make?
Well, it is a data point to take note of, because I think when people saw the unemployment report and they saw it tick up to 4.3%, we're now entering this trend period where unemployment is on the rise. And that's never a good thing after it's been so low. If you look back over history, when it gets about a 0.5% rise or so in unemployment off the lows, it's usually been a signal for a recession. But I think that's one of a couple data points that's been occurring in the market right now. When you look at earlier in the middle of July, we saw this huge rotation in the Mag 7 kind of techie names and into small caps and other areas. And that rotation really started the trickle down effect, because these names in the Mag 7 are such big weightings in the indices and in ETFs all over the place, that those names really then, when they start to be sold, that leads to index being sold. And then all of a sudden you have this ripple effect that occurs in the marketplaces. So then you get a fundamental unemployment report like we saw, and we've seen some jobless claims numbers tick up, although Thursday obviously was a little better. That maybe caused the rally to sort of unwind itself, or the sell-off to unwind, and then we saw a little bit of rally in the market here. But the unemployment report is going to be key, and then we have inflation data next week, so we'll see what happens here if this rally can sort of hold.
Right. Well, Mark, I think some of the revisions too are having investors scratch their head when they think about the validity of the data that is coming out.
Yeah, I think we can look at last week's payrolls numbers, but it's in our view, it's generally a bit of a noisy metric week to week. And I think what we believe is a bit more important is really to look at the trends in unemployment, even as Brian mentioned. In fact, like we said, as Brian mentioned on Thursday, we saw an initial jobless claim number that was quite strong in comparison to Friday's payroll numbers. So bottom line is, while we think that, unemployment and recession risk certainly exhibit some degree of correlation, it may be a bit nuanced this time around, I'd argue, that the uptick in unemployment likely more related to an increase in labor supply versus perhaps, an increase in job losses outright. And, I know that the SOM rule gets thrown around a lot, I think, but, it's important to remember that the SOM rule is really designed assuming a drop in labor demands more so than an increase in labor supply.
Mark, what is the bond market signaling?
I don't think there's necessarily warning signs or signals, but I think a couple specific technical factors may have exacerbated the sell-off last week. When we saw volatility spike on Monday, we saw credit spreads widen just a bit, but historically a move in the VIX of that magnitude really followed by a significant, it's typically followed by a significant credit deterioration. Though we don't have full transparency, we think that it may have been caused a bit by, some of the Japanese carry trade unwinding, a bit of a factor, and that this week's moves in the bond market were, again, driven by more technical factors. Now, look, I think, the bond market's really been trying to find a reason to get ahead of the Fed, and between, again, the carry trade disruption and weaker than expected payrolls numbers, I think the bond market reacted as we'd expect it to react in the face of this news.
Right. And Brian, speaking of technical levels, give us your perspective on bonds. And of course, what levels are you watching in the Nasdaq 100? Because the concentration of those stocks are listed, in fact, on the Nasdaq 100.
Yeah, I mean, I think when you look at the bond market, you saw the 10-year fall below 4%. I think it was a clear signal that there was some flight to safety going on. We've heard about all the selling going on by Warren Buffett and Berkshire Hathaway on some of the big names like Apple, which obviously leads to some selling in the market as well. But when you look at the Nasdaq as a whole, I'm looking at the 18,500 mark. It's really kind of bounced around there. I think it's a very key level. We've done some option trading around that area. And really the downside risk, I think, to the Nasdaq is maybe 16,500 on really an extreme move down. But I think if it can kind of hold this 18,500, I would look for it to bounce. Mark mentioned about all the volatility in the credit spreads. I think that's an important note to take of, because obviously if the credit spreads haven't widened out, it means that systemic, risk to the stock market really isn't quite there that we normally would see in credit risk. And so for that, you get a huge flush out like we saw in the market, a huge amount of volatility and almost like this pukage effect. And the Nasdaq to hold that 18,500 area, I think if it gets back above there, stays above there for a couple trading days, maybe we can push back to 19, 20,000 on the Nasdaq.
Yeah, and Brian, let's talk about volatility for a moment, because in our segment just, in the middle of July, we were talking about how low levels were and how cheap it was to put on some protection. That you get the spike on Monday. We were trying to correlate it to other spikes of volatility over the past 20 years. But then when you look at where spot was versus the futures, it told a very different story. Do you think the reaction perhaps was overdone in real time?
I think it was. I mean, the VIX and the volatility, we saw a 65 level, and yet the VIX futures were trading well off of that. There was this sense of panic. And I think the reason being is, I have like a little bit of a chart here just to kind of share on what things looked at. I think what maybe triggered this was just a little bit of people on the put side of things. Now, we look at this index here. We look at a measure of the value of a downside put in the S&P versus an upside call. So the put is really an explanation of insurance portfolio protection that people use. And we've had this spike about a handful of times over the last 15 years, call it, where there's been this huge surge in downside put demand. And what does that do? Dealers selling that put, selling that insurance, have to hedge themselves and sell the market. And so they basically backed off the market. We saw the VIX spike. They sold out the insurance. They sold the market. And what typically happens is after that sort of settles down and this huge rush of demand for puts on the S&P 500 sort of settles in a little bit, it's actually been pretty good buying opportunities. If you look at these other handful of times, just as sort of that skew has come off now, we see call buyers coming back in over the last couple of days. It's probably a little bit of a bullish sign for the market.
Right. And of course, market all depends on your time frame, right? Volatility that we've seen intraday could be great for day or swing traders. But if you're a longer term investor, to either get out of the market or not stay invested, you've looked at charts. I mean, for the most part, we're familiar with this narrative that you've missed out on great opportunities. I mean, if you're thinking longer term.
Yeah, I think I agree. And, as bottom-up investors, we're always happy when company fundamentals start to matter, which doesn't always seem to be the case. At the start of the year, I'd say the relative value discount between large cap growth, U.S. companies, and the rest of the broader markets have been at some of the widest discounts that we've seen in recent memory. Large cap growth today sitting at over 28 times forward earnings. When you compare that to high quality small caps, trading around 14 times forward earnings, I'd maybe start to think about paring back some exposure from some larger tech and discretionary names that have done very well. And I look to slowly, ease into maybe some lesser loved, higher quality companies in the small and mid cap space.
Right. And of course, Mark, we have to talk about earnings here, right? NVIDIA, it is such a cornerstone of what's happening, not only within the economy, but the stock market overall, as we switch or as we evolve into, this very tech-driven economy. What happens with NVIDIA matters. So what are you going to be looking for? What are some potential impacts to stocks that relate to it, whether it's the semi space or just the market overall?
Yeah, absolutely. I think it's hard to bet against NVIDIA. I think what we need to keep an eye on this earnings release really is forward guidance, as we've seen a lot of the CapEx spend, a lot of tech companies, Alphabet, Meta, and others, really come under scrutiny as investors are getting less patient with the translation of these CapEx figures into revenues. It's, we're in this show me now environment, and we really want to see what, if any, ripple effect that might have in forward guidance, as some companies may start rethinking their CapEx spends, or at least trying to rein that in a little bit.
And Brian, from an options perspective, what are traders pricing in terms of how they think it could go from either up or down?
Yeah, right. I mean, when you look at the level of volatility in NVIDIA over the last few trading days, it's been tremendous. I mean, you're talking about a stock that was over 100, back down below 100, making, 10, 15% swings. And so option traders obviously are pricing a much greater move than normal in the, post earnings. But when I look at, Taiwan Semiconductor's earnings came out, they were pretty bullish. The stock kind of hung in there. And obviously their biggest customer is NVIDIA. So, that's maybe a little bit of early indication that things in NVIDIA in terms of earnings picture might be okay. And I think if you're an options trader, there's probably some trades that people are looking at where you can use some put spreads that I commonly use to sort of hedge downside risk. But that would be somebody that's really trying to take a protective view on the stock. I think this is really still a stock that needs to be a cornerstone of the portfolio. Does it need to be a weighting of, what it is in the indices? That's something for somebody to decide. Obviously, that's playing a factor in a lot of the volatility that we're seeing in the semiconductors as a whole. But here's a stock that just had a tremendous amount of volatility. And I think option traders are really looking to maybe reposition, use some of that volatility to sell options against that and reposition themselves post earnings if earnings, come out as good as let's say Taiwan Semiconductor just had.
Yeah, it's so interesting, Brian. Some of these stocks like NVIDIA or any of the mag names, right? If you weren't in there and you have to think about your performance as a portfolio manager, perhaps if you get this valuation reset, right? Play some catch up here. So, I mean, there's so many narratives that you can assign to this.
That's right. And that's why option traders do actually like to use options to reposition it and just recalculate some of the risk, especially on the downside, because here's a stock that's become, like I just said, a big weighting in the Nasdaq, a big weighting in the S&P and other ETFs related to the chip sector. And so using some options sort of to control for something that has such a big weighting in the indices and have this amount of volatility that we're seeing over the last few trading days, it makes sense to use some options to dampen down risk and take other ways to position yourself in this sort of name.
All right, Mark, Brian, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.